fast, where truth moves faster than a Holstein calf. No waiting on some pretty page. We're charting new ground in the digital age. From genomic codes to row-out facts, we cut through the noise, no holding back. Not your daddy's dairy news tonight. We're sparking debates with every insight. The ring's not where the real fight's at. It's in the data, in the channel chat. From pasture to processor to your morning cup, we're raising the stakes. Try and get ahead of herd. Yeah! Where the future's more than just a word. Ahead of herd. Come on! The bullvine's calling, let your voice be heard.
Welcome back to the Bullvine Podcast, where we cut through dairy industry noise to get you the insights that actually matter for your operation.
We're here to give you the shortcut to being well-informed.
And today, that means tackling what might be the biggest biological and financial time bomb ticking away on American dairy farms right now.
And today, we're diving deep into a feature piece about the 2026 Dairy Reckoning, Navigating the Heifer Deficit. This isn't just theory, it's not a market fluctuation you can hedge your way out of.
No.
We are talking about a biological time bomb that was set maybe 2.5 years ago by that massive 2023 beef on dairy boom. And the detonation is, well, it's happening right now in our replacement pens. Every farmer is feeling it, or they're about to feel it.
Okay, so let's unpack this immediately, because the headline alone from the research we analyzed is it's absolutely sobering. 438,000 missing heifers, $4,100 price tags. Beef on dairy's reckoning has arrived. This goes so far beyond volatile milk prices or high feed costs. This is a fundamental structural problem that producers across the country are facing because of breeding decisions they made when, frankly, all the market incentives were pointing them in that direction.
And it's hitting the balance sheets hard. For 2 years, we and, the industry at large, we talked about the great beef on dairy strategy as this universal no-brainer win.
Right. Better cash flow from the bull calves, better terminal animals.
A great story to tell. But now the cost of that short-term optimization is coming due. The executive summary we saw reports a median price tag for securing a replacement heifer is now a staggering $4,100.
Wait, I have to anchor that number for you. $4,100. Yeah. The sources show that just 2 years ago, back in April 2023, a standard replacement heifer was running about, $1,720? That is more than doubling. A 138% price increase in less than 30 months. This is not inflation. This is a supply shock.
It is a crisis, plain and simple. And if you are that typical 500-cow operation and you need 140 annual replacements,
which is a pretty standard 28% replacement rate.
For most people, yeah. You just added over $300,000 to your annual operating costs, purely to secure the replacements you need just to tread water and maintain your current milk volume.
$333,000 in sudden, non-negotiable expense.
That is the difference between profit and survival for most mid-sized dairies.
So our mission today is clear. We are absolutely going to challenge the conventional wisdom that beef on dairy was a universal win. We'll show that while it solved a short-term bull-calf problem, it created this massive, existential, long-term pipeline vulnerability.
But, and this is so crucial, the pressure on the system has created a historic opportunity. We are going to reveal a massive, time-sensitive opportunity that processors are actually offering qualified farms. I'm talking unprecedented financing, subsidies, and contracts. That's the good news we have to get to. But that leverage window is closing fast, based on the data we have, probably by the second quarter of 2026.
So if you are sitting on the fence about modernization or expansion or just securing your operation for the next 5 years, you absolutely need to listen closely to that segment.
For sure.
We must start, though, by facing the unyielding reality of the math and the biology. We have to start with the scale of the problem and understand why right now money cannot solve the immediate shortage.
It just can't.
Okay, let's jump straight into the core issue then. The numbers are just unavoidable. The CoBank Knowledge Exchange report, which is one of the most respected analyses we follow, puts a hard number on the deficit we are now facing. 438,844 fewer replacement heifers projected to hit the milking line in 2026 compared to the inventory we had in 2025.
That number, nearly 500,000, it's just abstract until you try to buy replacements. It's not just a statistic on a spreadsheet.
No.
It's what happens when you call a dealer and ask for 30 fresh heifers. The source material uses the perfect anecdote to anchor this shock, and I think every farmer listening needs to hear this. It's the story of the 650-cow Wisconsin dairyman near Fond du Lac. He was quoted $4,100 per head just a few months ago in September of 25.
And that was up from $1,800 just 2 years prior.
Right, in the spring of 2023.
I can just hear him saying it. I actually asked the guy to repeat himself.
Exactly. That shock is entirely real. You plan your balance sheet, you build your budget based on an $1,800, maybe a $2,000 animal, and then suddenly your single most essential capital cost, the future of your milk check, it just doubled.
That forces a complete operational rethink.
Yeah.
Usually under immense stress. And we have to recap why that temptation was so overwhelmingly irresistible back in 2023, because it wasn't a dumb decision in a vacuum.
Yeah.
When you looked only at the immediate short-term cash flow, the math made perfect, undeniable sense for the survival of the day-to-day operation.
It was the easiest cash flow boost available. Everyone grabbed that low-hanging fruit. And look at the premiums. Beef cross calves, particularly those F1 crosses that looked good to the feeders, they were bringing $400 to $800.
Right.
You compare that to a straight dairy bull calf, a Holstein bull calf that was going for maybe $50 to $150 if you were lucky enough to find someone who wanted him.
So that's an immediate guaranteed $350 to $750 difference per calf.
Per calf, landing in your pocket within days of birth.
And the breeding costs only amplified that immediate intoxicating benefit. This is where the long-term cost gets obscured. If you were using premium beef semen to get those high-value calves, you were looking at maybe, $8 to $15 per straw.
Super low risk, high immediate reward.
But if you wanted to build your herd responsibly, using sex dairy semen, the proper, deliberate way to ensure your future replacements.
You were paying $25 to $40 per straw. The cost difference was massive. The success rate for sex semen was lower than conventional, and the benefit, that heifer calf, was a gamble 30 months away.
I mean, I get it. Farmers operate on brutal, tight margins, often needing to manage cash flow week to week. When you're looking at an extra $500 per calf right now versus a replacement risk that doesn't fully materialize for 2.5 years.
The short-term cash flow benefit of those beef calves just completely overshadowed the long-term replacement risk for so many producers.
They essentially made a perfectly rational decision based on the immediate pressures they were facing.
But it was a decision that leveraged the future against the present. They mortgaged their pipeline, and now that mortgage payment, that $4,100 per heifer, is due. It's a painful lesson in biological and financial leverage.
And this brings us to the hard reality that you can't optimize your way out of the fundamental biological constraints.
Nope.
Biology does not negotiate. You mentioned 30 months. And we need to walk through that timeline again for clarity, because it's the non-negotiable factor here.
It's math, not magic.
Yeah.
You start the clock when you breed the cow. You've got the 280 days of gestation, 9 months, give or take. That calf is on the ground.
Okay.
Then she has to grow and develop. That takes another 22 to 24 months before she's ready to freshen and enter your milking string.
So total time elapsed.
Roughly 30 to 33 months. Even with the best management, perfect nutrition, and the fastest developing genetics, there is no shortcut. You cannot pay your way out of that timeline.
Which means the 2026 and really much of the 2027 shortage was locked in by the breeding decisions made throughout 2023 and 2024. If you didn't put sex dairy semen in the right cows 30 months ago, that animal simply doesn't exist today.
And throwing money at the problem only drives up the price of the few animals that do exist. And that's why I found Dr. Albert de Vries' quote from the University of Florida so profound. He stated in his research, "You're managing consequences, not preventing them."
The prevention phase is long past.
Long past. You are in the damage control phase. You are essentially trying to patch a pipeline that has already run dry.
So let's put the cost in stark relief for that mid-sized dairy. We already established the massive price jump. For the 500 cow dairy needing 140 annual replacements. In 2023, the total annual replacement cost was $240,800. That's based on $1,720 per head.
Okay.
In 2026, that cost is $574,000 or more based on the median $4,100 price tag.
Wow.
That almost $335,000 difference has to be absorbed or financed or pulled from operating capital. That scale of non-growth capital expenditure just crushes margins.
And it's not just the purchase price, it's the supply chain strain. The source material points out that the real-world evidence of the shortage is everywhere, and it speaks to the saturation of infrastructure. Custom heifer rearing operations across the upper Midwest, the guys running 400 to 1,000 head, like that major Pennsylvania operator, they are completely fully booked through 2026 and are actively turning away new clients.
Wait, I want to drill down on that. If they're turning away clients, that means the farmer who suddenly realizes they need replacements and realizes they don't have the time or the labor or the space to raise them. They're just stuck.
They're stuck.
They can't just outsource the problem.
Exactly. The initial beef on dairy decision was often paired with, hey, we don't need to raise as many heifers so we can save on labor and space. Now, even if they decide today, okay, I'm going to breed for replacements, and they successfully get those calves on the ground, finding someone competent to raise them professionally for the next 2 years is nearly impossible.
So the infrastructure is saturated.
Completely saturated. The dedicated heifer ranches are full because everyone who is smart enough to keep breeding dairy in 2023 is already occupying that space. That adds a huge labor and management pressure back onto the farm that they desperately tried to avoid in the first place.
Before we move on to solutions, just a brief mention on the global context. While the U.S. scale is unique because of the sheer volume of beef on dairy adoption, other markets are also feeling pressure.
Right. The EU is facing major herd pressure due to their Green Deal and farm-to-fork strategy, which is pushing down their capacity.
Which means we can't just import cheap replacements to solve this.
No. The global supply is not going to bail us out, which it sometimes does. In fact, if we could stabilize our supply, the structural tightness in Europe might open up export opportunities for U.S. milk down the line.
But right now,
the global market offers no relief for our 438,000 missing heifers. We have to solve this internally.
Okay, so we've established the 30-month clock is running and the cost jumped to $4,100. We can't rewind the clock.
But we can immediately change the replacement rate without making a purchase. And this is where the strategy lever of extended lactation protocols comes in.
Extended lactation. So pushing cows to milk 14 to 18 months instead of the traditional 12-month cycle. The research cited shows it can reduce replacement needs by 15 to 25%.
And I know a lot of legacy producers view extended lactation with inherent skepticism. They look at the typical lactation curve and they say, my cow starts dropping production after month 12. Why would I keep a less efficient cow around for 4 more months?
That's a fair question.
It is, but that reasoning completely misses the new economic reality. The ROI math has fundamentally shifted because of that $4,100 heifer price.
Let's absolutely break down that ROI mess because this is where the money is saved and where the data overrides tradition. Yes, a cow at month 12 is persistent, but she's still dropping. If she was milking 85 pounds daily at peak, she might drop to 68 or 72 pounds by month 16.
That's a 15 to 20% drop in volume. It's undeniable.
But you have to compare that milk drop against the eliminated costs.
That's the key.
You are offsetting the entire $4,000+ heifer purchase cost. That's a capital expenditure you simply don't have to make.
And on top of that, you eliminate the entire dry period and transition period costs, which research puts at $800 to $1,200 per animal.
And that transition cost includes the specialized dry cow feed, the breeding expenses you would incur, and critically, the high health risk inherent in any fresh cow transition.
That is the key insight. A mid to late lactation cow is generally the most stable, lowest risk, and lowest cost animal to maintain in your entire herd.
You pay less for feed, you have virtually zero risk of metabolic disease like milk fever or ketosis.
And her chance of a severe mastitis episode is significantly lower than a fresh cow. So you're trading slightly less efficient milk production for massively reduced health and capital risk.
And this isn't theoretical. The source material highlights the central Wisconsin producer milking 850 Holsteins. They successfully moved 130 cows to 16-month cycles. That meant they needed about 55 fewer replacements that year.
And the savings.
An estimated $220,000 in savings just on replacement purchases. That's pure, immediate cash flow relief right when they needed it most.
But they didn't just pick 130 cows randomly, right? This requires selection. This is where the farmer needs to apply the data.
Absolutely. If you keep a marginal cow milking longer, you turn a small problem into a long-term economic drain.
You cannot just keep your bottom 25% milking longer. That's a huge mistake. You have to be aggressive in selecting the right candidates. And the UW-Madison research provides clear, data-driven criteria for success.
Let's detail those selection criteria. This is not guesswork. This is precision agriculture needed now. First,
Persistency ratings. They have to be above 105 relative breeding value. This is non-negotiable.
and that just measures how well a cow maintains production after her peak.
Exactly. If she's persistent, the drop-off is minimal enough to justify the savings.
Second, somatic cell count consistently below 200,000. Udder health has to be solid.
Right, because if you keep a cow that constantly flirts with subclinical mastitis, you can't afford to keep that chronic health risk around for an extra 4 to 6 months. A flare-up in month 15 could easily land her in the hospital pen, negating all your savings.
Okay, third, no chronic lameness or recurring health issues.
A cow struggling on her feet should be phased out and culled quickly to capture that high terminal value. Keeping a lame cow milking longer is an expensive, welfare-compromising choice.
And finally, body condition score, or BCS, holding at 2.75 to 3.25.
That's the metabolic sweet spot. A cow that holds her weight well, not too skinny, not too fat, is metabolically stable. If she drops too low or gets too high, she's not a candidate.
And that precise selection strategy is essential, but we have to adjust the caveat.
Yes. Dr. Paul Fricke, also at UW-Madison, reminds us that cows going significantly longer between calvings can have more difficulty conceiving on subsequent cycles.
So it's not a perfect solution.
It means the extended lactation cow needs a more aggressive and targeted breeding strategy when you eventually do breed her back. You need to manage her metabolic health and subsequent fertility carefully. It's an interim measure, not a permanent retirement plan for your replacements.
So it's not a blanket policy. It's about scientifically managing that top 25 to 35% of your herd differently to create a necessary gap in your replacement requirements for the next 2 years,
It buys you time.
buying you time until your newly structured breeding pipeline comes online.
Exactly. Now that we've bought ourselves some time with extended lactation, let's look at the long-term fix, which is fixing the breeding policy that created this crisis in the first place.
Right. The most successful operations, the ones positioning themselves for 2028 success, are implementing what's called tiered breeding. It's a systematic approach based on genetic merit. Producers who went 60 to 80% beef are now pulling back, ensuring 50 to 60% of overall meetings produce dairy replacements.
This is where genomics has shifted from being an optional luxury to being a survival necessity. When heifers cost $4,100, you simply cannot afford to waste expensive sexed semen on animals that will only produce mediocre offspring.
Let's talk numbers on the role of genomics. A genomic test costs a farm about $35 to $50 per head, typically done on heifer calves at 2 to 3 months of age.
So what does that $50 get you?
It provides over 70% reliability on that calf's genetic future, her net merit, her TPI, her production potential, long before she ever enters the milking parlor.
That level of precision is the key to preventing the $4,100 mistake. Think about the contrast. Before genomics, you used $40 sex semen on your best-looking cows, hoping the calf was genetically superior.
Just hoping.
Now you use a $40 genomic test to know if she's superior, and then you decide how much you're willing to invest in her entire 30-month rearing process.
The cost of that genomic test pays for itself exponentially when it prevents you from wasting $40 sexed semen on a heifer that should have been bred to beef anyway.
It's risk mitigation built on data. It ensures that every dairy heifer you raise is worth the massive capital investment you are now forced to make.
So let's detail the 3-tier protocol that successful producers are now adopting based on this genomic data.
Okay, Tier 1. These are the herd builders. The top 35 to 40% of your herd. These are your elite dairy animals. They've ranked highest on their genetic merit indexes, high net merit or TPI.
So they're the only ones getting the good stuff.
They are the only animals that should be bred to elite dairy sires using the most expensive sexed semen, which runs $35 to $45 a straw. This isn't just replacement insurance. This is an investment in genetic progress.
Okay, so that's Tier 1. Then we have Tier 2, the replacers. This is the middle 30 to 35%.
Right. These are your average genetics. They're reliable, healthy, and perfectly capable of producing commercial milk, but they aren't pushing any genetic boundaries.
So what do they get?
They get conventional dairy sires. No sexing premium needed. Solid genetics, predictable outcomes. They reliably meet the numbers you need, especially when combined with the Tier 1 offspring. This maintains your replacement quantity.
And finally, Tier 3, the terminal animals. The bottom 25 to 30%.
This is where beef genetics make perfect targeted sense. These animals are already destined to exit the herd soon based on low production, poorer health profiles, or just overall genetic merit.
So breeding them to beef maximizes their terminal value.
It creates that guaranteed $400 to $800 calf premium without compromising your essential replacement pipeline. This is where you recapture the cash flow benefit without leveraging your future.
That systematic, data-driven approach is the only way forward. The key insight is that the industry realized the hard way. Not every cow should leave genetic offspring in your herd, but enough of them absolutely have to be the right ones.
And that 50 to 60% dairy mating threshold is the necessary correction to the irresponsible 70+% beef matings that dominated 2023.
You must use genomics to identify the genetics that justify the $4,100 investment in rearing them.
Okay, so let's transition from what the farmer must do on the breeding side to the biggest market dynamic shift we've seen in a decade.
This is where the structural imbalance created by the deficit creates massive opportunity for the farmer. We're talking about the supply-demand flips, creating unprecedented leverage with processors.
It's truly astonishing. For the last 10 years, we've been living in a world where processors always had the upper hand, constantly telling farmers, there's a glut, we have too much milk.
Right.
Now, they are the ones sweating because they have built monumental processing capacity that is sitting half empty.
Exactly. The sources cite $11 billion in new processing capacity coming online between 2025 and 2028. Major investments by Hilmar, Leprino, Glanbia, and others, particularly in the upper Midwest and Southwest.
And these plants were designed to run at 85 to 90% utilization to be profitable and justify that investment.
And because the heifer deficit is choking milk supply growth, we aren't growing at the 1 to 2% annual rate they modeled.
Those multi-billion-dollar plants are currently running at 60 to 70% capacity.
That is a massive, crushing, sunk cost for those companies. It's a genuine processor crisis.
It might be the first time that processors have been this vulnerable to dairy supply since the early 2000s.
One procurement manager quoted in the feature piece admitted, and I love this quote, "Nobody modeled what happens when a significant portion of the national herd stops producing dairy replacements for 2 years."
They projected supply based on historical growth trends, and the growth just stalled. They desperately need guaranteed long-term milk flow to justify that infrastructure investment. They need us more than they are used to needing us.
This is the leverage window. The power dynamic has temporarily flipped.
And they're willing to put up massive capital to secure supply.
So let's detail the unprecedented terms they are offering qualified farms to secure future milk, because this is where a farmer can fundamentally reshape their operations' financial future.
Number one is heifer financing at a discount.
Okay, what kind of discount?
Processors are offering direct financing for expansion or replacement heifers at 4 to 6% interest.
Compare that to the 7 to 9% rates traditional agricultural lenders are charging right now.
On a $2 million loan to secure 500 heifers over 5 years, that 3 percentage point difference translates to saving over $150,000 in interest alone. That is money staying on the farm.
Wow. Okay, what else?
Equipment subsidies. This is truly mind-blowing. They are covering 40 to 60% of robotic milking system installation costs in exchange for long-term supply commitments.
They're co-investing in the efficiency of the farm.
To guarantee the milk. And these subsidies aren't just for any technology. They often favor high-throughput, labor-saving tech. A processor needing a rapid influx of milk might offer a higher subsidy for a rotary milking system expansion versus a more modest subsidy for an automated box system.
They're tailoring the subsidy to the type of milk they need to secure.
That's right. And then there's forward-locked pricing. Farmers are locking in prices 12 to 36 months out, often 80 cents to $1.20 per hundredweight above the current spot market.
That guaranteed premium provides the income stability needed for serious long-term capital investment.
And it makes that 4 to 6% financing even more appealing. And let's not forget the volume premiums. They aren't just trying to maintain supply, they're trying to fill those capacity gaps. So they're offering significant bonuses for commitment to 10 to 20% growth. They are paying you to solve their problem.
But there are strict qualification requirements. This isn't a free-for-all. What metrics do farmers absolutely need to meet to get this deal?
The bar is high because the processor is taking on risk. You have to prove financial stability and a history of quality production.
Like what?
Size, first of all. You typically need 500-plus cows currently milking to offer the necessary volume. Component quality is critical approaching or exceeding 3.2% protein.
Which aligns with the FMMO value shifts.
Directly. Also, you need a healthy debt-to-equity ratio, usually below 50%. They won't finance a failing farm.
And a commitment, I assume.
A serious 5 to 7 year exclusive supply commitment, often with steep penalties for early termination.
That brings up a critical point. Risk. While the terms are amazing, signing a 7-year contract locks you in. What are the risks of that kind of commitment?
The risk is future flexibility. If 3 years down the road, a competitor offers a significantly better price, or your operation decides it wants to pivot to a niche like organic, you are contractually bound.
So you need a good lawyer.
You need a good lawyer, not just a good salesman. Farmers signing these deals need to ensure there are reasonable escalator clauses tied to input costs, and they need ironclad force majeure clauses to protect against unforeseen events.
But despite the risk, if you meet those metrics, you have to be picking up the phone right now.
Absolutely, because that expiration date is non-negotiable. This window is realistic only through Q1 or Q2 of 2026.
Once that capacity fills, even if it's only to 80%, or supply concerns start to ease.
Negotiating power shifts instantly back to the buyers, and those 4% loans vanish overnight.
For those listeners who are struggling, who simply cannot meet those processor qualifications, or who are feeling the compounding stress of the last few years, high feed, low margins, and now $4,100 heifers.
We have to talk about strategic exit.
And we need to frame this not as failure, but as market recognition, capitalizing on peak cattle prices and preserving family equity.
This is the hard, honest conversation that too many producers avoid until it's too late. Cattle markets are historically cyclical, and we are currently in a cycle that offers historically favorable exit conditions for selling off your assets. You have to be realistic about the current market data.
Let's review those favorable exit conditions right now, specifically for selling your herd.
Okay. Finished beef-on-dairy steers are bringing $200 to $255 per hundredweight near all-time highs.
The average beef-on-dairy slaughter cattle are netting $24.85 per head.
And critically, U.S. cattle inventory is at a 73-year low, the smallest since 1951. This lack of beef cattle supply supports continued strong terminal pricing through at least 2027.
So if you are already struggling, timing your exit to these peak prices is the difference between preserving family equity and forced liquidation later.
The financial difference is staggering, and this is based on extensive financial modeling. Strategic exit in months 8 to 10 of clear financial stress preserves $300,000 to $500,000 more family equity than waiting until months 16 to 18 when the bank forces your hand.
And you're liquidating stressed animals into a less favorable market.
Exactly.
That $500,000 difference can be retirement security or the capital needed to transition the land use. The anecdote about the Minnesota couple who exited their 380-cow dairy underscores this perfectly. Their children weren't interested in taking over. The heifer prices were the final trigger.
And they netted $1.4 million after debt payoff. They looked at the numbers and made a hard, smart business decision while the valuations were high.
It's smart business, but it requires radical honesty. What are the stress signals that warrant immediate evaluation of an exit strategy?
Okay, here's the list. 3 or more months of negative cash flow with no clear path to reversal. Debt-to-equity ratio above 50% and climbing.
No processor contract, meaning you're fully exposed to spot market volatility.
Great. And replacement costs consuming more than 25% of your total milk revenue. If you're spending a quarter of your income just to buy inventory, you are upside down.
And the last one is personal. If the primary operator is 55 to 65, with no clear, formalized succession plan in place.
And if you're evaluating exit, you must talk to an agricultural accountant about structuring the sale across 2 tax years.
That Minnesota family did this to maximize capital gains treatment. That tax planning detail alone can save tens of thousands of dollars.
All of this financial pressure is accelerating a structural shift in the industry. The consolidation is real.
Projections show we are likely going from 22,000 dairy farms today down to maybe 14,500 to 17,000 by 2028, 2029.
This heifer crisis isn't just a bump. It's compressing a 10 to 15-year transition into maybe 5 years.
And what emerges, according to Stevenson and UW-Madison analysis, are two dominant, successful models that are squeezing out the middle ground. The $4,100 heifer is only widening that gap.
Model 1 is the integrated mega dairy. These are 1,500-plus cow operations, like the massive milk source operations. They run their own feed mills, calf ranches, and cropping operations. Vertical integration, advanced automation.
And exclusive contracts.
Right. They allow them to achieve 15 to 20% lower per unit cost than the industry average. They succeed purely on scale and system control.
Then there's Model 2, a specialty or niche producer.
These are the smaller 100 to 500 cow operations. Think John Banson's organic, grass-fed model, or A2 producers. They focus on certified niche market segments.
So they bypass the commodity markets.
And capture price premiums of 30 to 60% above conventional markets, offsetting their lack of scale efficiency.
And the squeeze is happening right in the middle. The mid-sized commodity dairy of 500 to 1,000 cows, producing undifferentiated milk without major long-term contracts or specialty positioning.
They are too small for the mega dairy efficiencies and too large for the niche pricing structure. That is the segment facing the absolute most pain from the $4,100 heifer price, and they must either expand rapidly or differentiate immediately.
All right, we've covered the crisis, the unyielding biology, the cost, the critical processor opportunity, and the necessity of strategic exits. A farmer just finished milking, pulled up the Bullvine podcast, and is now driving to the feed store. What are the three most critical things they need to remember from today, right now?
They need to remember this. You cannot buy your way out of the 30-month constraint, but you absolutely can manage your way out of the high cost and the high risk.
Takeaway 1, reinforce your replacement pipeline. What's the immediate action they need to take this week to stabilize their pipeline?
If you haven't already, implement selective extended lactation protocols. Use your DHIA data to identify those top 25 to 35% of persistent healthy cows, high persistency, low SCC, and transition them to 16 to 18-month cycles.
This immediately drops replacement needs by 15 to 25%.
Without requiring you to purchase a single $4,100 heifer, it's the fastest cash flow control measure available.
And the medium-term strategy for the next 3 to 6 months.
You must restructure your breeding mix immediately. Pull back on the beef matings and ensure 50 to 60% of your total matings are dairy producing. If you wait another 6 months, you've locked in another 6 months of deficit that you'll be paying for in 2029.
For long-term positioning, looking 1 to 2 years out, how do they ensure this crisis never happens again?
Adopt genomic testing for all heifer calves, period. The $40 to $50 investment pays off by ensuring that your $35 to $45 sexed semen only goes on the animals with the highest genetic merit, that top 35 to 40%. You stop guessing and start using data.
Okay, takeaway 2. Capture leverage or capture equity. Given the urgency of the processor window, what's the immediate action here this week?
Contact your cooperative or potential new processor today about long-term contracts, heifer financing at 4 to 6% interest, or equipment subsidies of 40 to 60% coverage. You have immense leverage right now that you will lose by Q2 of 2026.
It's a limited time sale on the future of your operation.
That's right.
If the operation is financially stressed, what's the medium-term strategy?
Get an unbiased valuation immediately. Consult with an agricultural accountant to understand the financial implications of a potential strategic sale. Explore structuring that sale across 2 tax years to maximize capital gains treatment and preserve that essential family equity while cattle prices are at historic highs.
And the long-term positioning for those who are staying and growing in the commodity market.
Target 3.2% or higher protein components. The FMMO value shifts favor protein, and processors are desperately seeking higher component milk to feed their expanded capacity. Align your genetics and your feed program with this shift for maximum long-term revenue.
Finally, takeaway 3, build your safety net. What's the immediate action they can take this week to stabilize risk and protect cash flow?
If you haven't, enroll in the Dairy Margin Coverage, or DMC, program. Coverage has been extended through 2031, and the Tier 1 coverage limit is now up to £6 million. Multi-year enrollment locks in a 25% premium discount. That insurance floor is absolutely essential.
For the medium term, 3 to 6 months out.
Explore LGM Dairy Insurance Livestock Gross Margin. This is critical because it protects against the twin threats of high feed cost spikes and low milk price drops simultaneously. It's an essential tool for cash flow stability that complements DMC.
And finally, the long-term structural positioning.
Look honestly at the structural reality of the industry. Understand which dominant model integrated mega dairy or specialty niche your operation can feasibly achieve. You need to start making capital investments or market differentiation changes now to fit one of those two viable models, because the undifferentiated middle ground is only going to get tighter and more expensive to operate in. This has been another Bullvine podcast. We've covered a lot of ground today, but the message is clear. The cheap breeding decisions of 2023 have become the $4,100 crisis of 2026. The time to act is now, not when the bank calls. For more straight-talking industry analysis and to read the source material we covered on genomics and processor leverage, head to www.thebullvine.com.
Subscribe wherever you get podcasts. We're out with new episodes every day, and upcoming topics will include an in-depth analysis of the new 950 DMC coverage levels and exactly what they mean for hedging strategies going into the 2027 volatility. The 30-month clock is running, and you've got to decide if you're breeding for 2024 spot market or 2028 structural reality. Thanks for tuning in.